With inflation data and bank earnings coming this week, we now welcome in Yahoo Finance's Alexandra Semenova on what we can expect to see in the week ahead. Alex, very, very busy week. We have some Jerome Powell. He will be speaking tomorrow, but of course, all eyes on bank earnings on Friday.
Indeed, Brian, the market's climb higher will be put to the test this week with a bunch of potentially market-moving events. We have the CPI report on Thursday, which is arguably the most important economic release of the month. Federal Reserve Chair Jerome Powell is slated to speak in Sweden tomorrow at a symposium hosted by the central bank. And on Friday, JP Morgan will report earnings along with some of its banking peers, Citibank, Bank of America, and Wells Fargo. Now, on Thursday, December's consumer price index is expected to show another slowdown in inflation. Estimates have the headline figure at 6.6% and core CPI at 5.7%. And this report is likely to dictate bets on whether the Federal Reserve will raise interest rates by 25 basis points or 50 basis points February 1st at its next decision delivery. Because so far, the reports that we've gotten have kind of been a mixed bag. The jobs report, manufacturing data kind of haven't given much clarity on what rate hike they'll go with, but CPI could provide some more insight into that. And then, of course, on Friday, JP Morgan, the largest consumer bank in the U.S., will lead earnings results. Banks typically benefit from higher interest rates because it boosts their net interest income, or the spread between the money that they make on lending activity and what they pay out to depositors. But that has been different this time around because challenging market conditions have dealt a blow to deal-making activities, which have offset that net interest income increase that they've seen. Things to look out for in bank earnings will be a drop-off in equity underwriting with a slower IPO activity, a drop-off in deal-making revenues, more potential layoff warnings. We have Goldman Sachs laying off people starting this week. And then loan loss provisions, or how much money banks are setting aside for potentially sour loans. And then, of course, a look at the U.S. consumer. Jamie Dimon is always quite vocal about this. He's been talking about a consumer-led recession, especially as inflation has eroded away the earnings that people have accumulated during the pandemic. The height of this was $2.1 trillion at the beginning of 2020, I believe. And now we're down below $1 trillion. So we're really seeing consumer spending really wipe away their earnings.
And we're also seeing the effect on a bank that has not traditionally had a big consumer business. That's Goldman Sachs, which we're learning is going to be cutting some jobs.
Exactly. Goldman Sachs is expected to start layoffs this week, laying off more than 3,000 workers. And the important thing here is the bank typically weeds out underperforming bankers at the end of the year. It calls about 1% to 2% of its workforce. It paused this during the pandemic and brought back those performance reviews last year. However, this goes far beyond the culling. It is really cutting costs wherever it can. This is another sector like tech that has overhired during the pandemic and now has to let go of some of those people. The interesting thing, too, is it has been the most vocal among banks about layoffs. JP Morgan, Bank of America have said that they're not laying off bankers just yet. So it'll be interesting to see from the earnings whether that changes at all.
Alexandra Semenova, thanks so much. Appreciate it.